All right, let's go back to our lead story, which we discussed last week, talking about South African economy regaining its rank as the biggest economy in Africa. And today we'll be discussing this further, putting both economies side by side. Indeed, no two economies can exactly be alike. Some are import-driven, export-driven, and sometimes mixed. In South Africa, 65% of total exports are commodities, and they are diversified over several different commodities. The country generates much more through manufacturing and the service industries. But although Nigeria has growth in these areas, mainly due to the large population driving a need for goods and services, it is not nearly as mature as South Africa. From a GDP value of $510 billion to the present assessed $296 billion due to weakened naira, the Nigerian economy is believed to have contracted by about 42% compared to South African economy that contracted from the assessed $370 billion to $310 billion. Indeed, South Africa regained the position more than 2 years after losing it to Nigeria as the value of the nation's currencies moved in opposite directions. Now, based on the country's GDP at the end of 2015, that's published by the IMF, the size of South Africa's economy is $301 billion at the rand's current exchange rate. Specifically, the rand gained more than 16% against the dollar since the start of 2016, while the naira lost more than a third of its value after the CBN removed the currency peg in June. Although both nations face the risk of a recession after contracting in the first quarter of the year, the Nigerian economy shrank by 0.4% in the 3 months through March from a year earlier amid low oil prices and output and shortage of foreign currency to sustain imports. In South Africa, GDP contracted by 0.2% from a year earlier as farming and mining output declined. The rand gained 1% to 13.3 cents per dollar at the close of business. That was yesterday. The Nigerian naira weakened, on the other hand, 2.7% to 320 per dollar. In the international market, South Africa exports gold, diamond and grains, while Nigeria exports crude oil and gas and cocoa. Well, the two countries have almost the same trade partners coming from Europe, America and Asia. All right, let's put this into perspective. I have joining me now Mark Bolland with Africa Africa and Middle East economist, Bloomberg Intelligence. He joins me now to discuss these factors responsible for this latest development. Many thanks for your time, Mark.
Yes, thank you. I mean, this is the shift between the nominal GDP in US dollar terms between South Africa and Nigeria this year is largely down to exchange rate. You mentioned the naira was devalued while the rand has done very well so far this year. You mentioned that the South African economy exports is very dependent on commodity exports, gold, platinum, and that was a factor that drove a 25% depreciation in the South African rand last year. But this year, the South African rand has actually done very well. I think it's up around 16–17%, but this actually has not very much to do with things in South Africa. The main driver of that is that interest rates in places like Germany, Japan, other places in Europe have gone negative on a lot of government bonds, and that's pushed out a lot of money, investments into high-yielded assets, where the South African government bonds is among the highest yielding assets, still investment grade rated. So that's what has pushed up the rand this year. So that's the main factor increasing or behind the recovery in the nominal GDP in US dollar terms for South Africa. But when it comes to Nigeria, the devaluation is very much down to the dependency on the economy of oil revenue, which of course has shrunk very much. So I do think the depreciation of the naira was needed to kickstart the economy, but also what is needed to increase the economy in nominal GDP terms back to where it was a couple of years ago, around $500 billion US, is for the economy to become less dependent on oil revenue. start producing other things within the economy. And it's correct, as the president says, that Nigeria is not an exporting economy, it's an importing economy. But now they actually need to produce domestically a lot of the goods which they previously imported using oil revenue. So,
all right, Mark.
I think the nominal GDP terms as we had 2 years ago.
All right, Mark, that's putting that into perspective on how this came about. But we'll take a break now, and when we return, we'll be looking at how Nigeria dropping its exchange rate ceiling. Was that wise? We'll look at that when we return on this break. Do stay with us. It's Business Zone on TVC News, and we're talking about South African economy regaining its rank as the biggest in Africa, taking over again from Nigeria. And I've been speaking with Mark Bolland, African Middle East economist, Bloomberg Intelligence. Mark, before we went on that break, you were putting this development into perspective. Now, the latest development is on the account of South Africa gaining strength against the dollar, whereas Nigeria, for her part, dropped its exchange rate ceiling. Was it a wise decision on the part of Nigeria?
I think it was necessary. As I mentioned, Nigeria is very dependent on the oil revenue. This has meant that the economy has been able to import a lot of stuff in paying with the oil revenue rather than producing it domestically. Obviously, now you're not getting the same amount of money for the oil that's being produced, and also the production levels have been falling due to the unrest in the Nigerian Delta, which means that they simply don't have the money to import as much as you've done previously. So the economy, your president and his team need to focus on trying to encourage people or facilitate for people to produce some of these goods domestically. Definitely think there's potential, maybe more in the agricultural sector. Nigeria imports a lot of the food stuff it consumes, and this is food, rice that can be produced domestically. So that is the way to go, in my opinion.
All right, let's talk a bit about rebasing now. Nigeria became Africa's largest economy after it was rebased. Rebasing happens when new sectors, product technologies, also consumer behavioral changes are calculated in terms of their impact on the economy. Now, talking about South African economy, popularly referred to as the continent's most industrialized economy, an edge Nigeria does not have at all. Now, what are the real odds in a comparative analysis? Was it worth comparing, really?
Sorry, can you repeat that question?
Well, I was looking at rebasing and how Nigeria was rebased. That's 2 years ago. Now, South African economy is popularly referred to as the continent's most industrialized economy, an edge Nigeria doesn't have at all. Now, what are the real odds in a comparative analysis, if you would?
Yes, I mean, industrialization is definitely something that Nigeria and a lot of other African countries need. I would also think that agriculture plays an important part here, not only Nigeria, but a lot of other countries import a lot of the foodstuffs they produce. But also, Nigeria needs to produce more of the goods, industrial goods that they consume. I think this is a bigger hurdle than maybe within agriculture, but Nigeria has the advantage that it has a big domestic market. A lot of other countries, the market is not big enough for companies, manufacturing companies, to achieve the economies of scale that you see in China and other places that are very big in manufacturing. But Nigeria has a big domestic market, and they can produce in scale, but you just don't have an enabling environment. I mean, definitely Nigerians, I won't argue that Nigerians are very entrepreneurial, but you need an enabling environment. You need to have reliable power, reliable infrastructure, and this is an area where Nigeria is very lacking at the moment.
All right, both countries face the risk of recession from reports. That's after contracting in the first quarter of the year. Now, with this news for South Africa, should South Africa be optimistic with this news?
Yes, I mean, as I said, a lot is the strengthening of the South African rand this year is largely down to interest rates going negative in the developing world, pushing out money into high-yielding assets like in South Africa. And also the central bank has raised interest rates by about 125 basis points last year, and this has put a brake on the economy. So I think what is going to happen during the second half of the year is that the central bank is going to move first to a more neutral stance and then look to paring back some of these interest rate increases in 2017. But a factor that is important there is that South Africa will most likely lose its investment grade credit rating later this year or early next year, which will make South African assets less attractive and could hit the rand and by extension inflation.
Okay, looking at Nigeria's currency policy, do you think it has a focused currency policy in place at the moment?
I think, unfortunately, Nigerian policymakers have wasted a lot of time and money by defending the Nigerian naira. I definitely understand that the weaker naira is causing a lot of pain, the higher inflation in Nigeria, but I think, unfortunately, this was unavoidable given the high dependency on oil revenue for the economy. And the weaker currency is a way for the economy to adapt, to stimulate other industries, to maybe become less dependent on imports, which it previously has been. And it's a more natural way to do this than to try to direct access to foreign exchange and to lending, which the central bank tried to do last year without really any success.
All right. Mark Boland, Africa Middle East economist, Bloomberg Intelligence. Many thanks for your time. We sincerely appreciate it.